Let's now get across to our first guest on the show. Madangopal Ramu, CIO at Sundaram Alternates, is now with us. Thanks so much, Madangopal, for taking out time for us. Let's start with the markets.
Thank
Indian markets. Feb and March were not that great. This relief rally, would you have expected?
Frankly, we thought that the downside risk for the market was very limited. If you look at the economic indicators, the numbers are coming through. You are seeing manufacturing PMI being strong, service PMI being stable. The job market in urban centers still looking better, and despite IT sector being weak. And also you are seeing credit growth being very strong. So fairly, most of the indicators are pointing to a very stable yet growing economy in a challenging macros, right? Inflation, interest rates are very high at this point of time. There are certain indicators which are weak, but still I think broadly the economy is doing fine. So given that scenario and earnings momentum continuing, we frankly thought that downside risk is much lesser in the market. Upside risk depends on how the earnings momentum goes from here, and that's why we are seeing that markets reacting to what is the guidance that these companies are coming out with in the pre-quarter period at this point of time.
Right. In terms of the quarterly numbers or the updates that have come in so far, what is the sense that you get? You get a sense that select sectors like banks continue to show strong growth?
Banks will continue to show strong growth at least another 1 or 2 quarters until the credit growth sort of moderates. But the key for banking sector has been what can happen on the deposit collection. There has been some challenges on the deposit collection, but some of the recent tax changes in other competing products, I think it's giving a breather now for the banking sector to, particularly the private banks, and to come back in terms of the deposit growth. If that comes through, then the pressure on the margins can be much subdued than what is being feared at this point of time by the street for the next year or second half of next year. So I would say things are moving on the positive direction for the banking space. Valuations are not very stretched, and these private banks have exposure to retail banking and they can continue to grow. Therefore, I think any relief on the deposit rates uh, can be a positive sign for banking sector to start doing well, in our opinion.
In terms of banks, how would you look at it? Larger the better or smaller book size which is trying to gain market share?
We generally play banking from the credit penetration story. The credit penetration still in India is fairly low compared to the other countries from a percentage of GDP perspective. Much of it has to be catched up from the retail point of view. So you will see over the next, say, 5 to 10 year time period, the retail credit growing minimum by 15%. And there are certain banks out of this, and particularly ones which have advantage of cost and using digital as an way to source new customers, they will always do better compared to say smaller banks which are struggling to match up in terms of cost of funding with these large banks. So you need to have the advantage of cost of funding, but that's not alone the case. They also have to have a capability to go and source new customers. I think most of the private banks in India, and particularly the large private banks, are doing it very well, and that's where our comfort is. We also play small banks or NBFCs, but there we are very conscious that we play only with those guys who don't compete with the large private sector banks or even large PSU banks. We play for banks or NBFCs which are playing this unorganized lending, moving people from unorganized lending to organized lending. So that is the theme that we play in the smaller banks or NBFCs. Broadly, much of the allocation is only to the large private sector banks, where we are very comfortable from a valuation as well as from a growth perspective.
Got the point. You look at where the market size growth itself in the organized space is very high.
Exactly. The growth will be substantially better and outgrow the overall economy as well as the banking sector growth as well. So that's where the opportunity is, and yeah, generally it is better played with profitable banks. That's been our theme always been, because banking itself is a leverage sector. It is better played through highly profitable banks here, rather than trying to play low profit here, because in downside in economic crisis situation, you'll have a large downside in banks which have a low profitability ratios. So we always play with private banks above 1.5% sort of an ROA. We keep that as a criteria.
So let's talk about the new age tech companies. You know, they saw a rage as far as listing is concerned. Now some of them are down 50, 60, 70% from their highs. Do you think, considering the growth opportunities they have, considering now that they're a part of the listed market, is there value, or you would wait for more correction? Because growth is something which is there into some of these names.
One thing is very clear, like over the next 5 to 10 year time period, you are going to see penetration into most of these service platforms are going to increase. Definitely, they had easy money flowing through. Therefore, the growth was much more superior in the last 5 years. Probably now these guys are now raised money from the market, so they have money to spend and increase the user base. But good thing that has happened is these companies have come and explained that they can grow without being non-profitable. So we are seeing them committing on profitability, which is a good sign to see, first thing. Second point is, obviously, market was very greedy when these stocks came into the IPOs and listed at fairly very high valuations. And there was nothing left on the table. A margin of safety was too low to play. After this 50 to 60% correction, or even much higher in some of the cases, I think now valuations are becoming much more debatable rather than completely avoiding the space. What we like about the space is in India we are getting an opportunity to play when the penetration level in these tech platforms are fairly very low at this point of time, and they can only go up. And if you look at some of the services, the penetration levels are in single digit, and they can go higher double digit in the next, say, 5 year time period. This has happened in every part of the world, and it will happen in India also, and more so in India. In the next 10 years, a lot of Gen Z population will move and become consumers, and they become consumers. They spend a lot of time on the online, and we are fairly confident that the online penetration story will be much better. But you have to be very careful on where you play this. We don't want to go and stretch ourselves and play in stocks where it will take a longer period to turn profitable. So we want them to have at least contribution level profitability and also valuation being very reasonable. And we are seeing opportunities. So we are slowly starting our exposure, increasing our exposure in this space.
Right, sir. Got the point. Sir, you know, it's been a while since traditional FMCG names, pharma names, which are considered defensive, have done well. In fact, you know, they've not done at all anything, and some of them have even declined. You think markets would start to focus on free cash flow, low capex once again, and that's where they would fit in?
So our broad assumptions are that the FMCG as a space will slowly will keep struggling for volume growth, and this has been the case for the last 4 or 5 years, and it will continue. If it is a good monsoon, probably the growth numbers might look attractive for that particular period. But generally, it's fairly penetrated the products. So if you are playing for the next, say, 4 or 5 year time period, it is better played through consumer discretionary. Obviously, during high inflation period, people won't bet on consumer discretionary because being a cyclical sector. But that's where the opportunity is. Today, given the kind of valuation that consumer discretionary companies are trading, despite many of them have delivered on earnings. Yes, there were some disappointments in pockets, but I would say fairly most of the companies have delivered on numbers. Despite that, these stocks have not gone anywhere. Therefore, you are getting at a reasonable discount some of these consumer discretionary names. So if you leave next 6 months to 1 year out of your context and then look at little long term, you are getting some of these companies at a real good bargain. 2022 was a year where people looked at market from because of high interest rate and high inflation, defensive stocks and dividend yield stocks, and market itself moved more towards yield products, right? So that played out in the equities also. Allocation was more towards yield companies, dividend yield companies, and defensive stocks. Low growth or even low growth, low PE stocks were favored. But I think as the inflation starts coming down in the later part of this year, I think interest on growth stocks will come back. And today the growth stocks are available at a good price, and consumer discretionary is a very good growth stock to play. And valuations are not very high as it used to be, say, 1 year. And therefore, I think that's the space to be for any investor who's taking a long-term view rather than say next 6 months sort of a view on the market.
In terms of growth stocks and value stocks, as you said about growth stocks in brief, where do you see the theme coming in? Whether it will be growth or value, where do you see theme over the next few quarters for flows?
I think growth itself has become a value right now because the valuations have corrected in the last 1 year or so. Even internally in our portfolios, where we have seen that our portfolios generally have a valuation of around 20 to 25% higher than market. Today, our portfolio valuations are closer to the Nifty 50 benchmark. Despite the earnings growth of our portfolio is substantially better than the Nifty 50 because we play growth as a theme and but at a reasonable price. And I would say that to stick to the theme, growth at reasonable price today, it looks like growth at attractive price. I would say that is the way the markets have treated growth stocks for the last 1 year or so. So therefore, I would say growth has become a value at this point. I can say that for banking also, growth has continued, but stocks have not reacted much, and therefore most of the banking stocks are looking value peak at this point of. Same I can argue for some of the manufacturing companies as well as for some of these consumer-facing companies.
Right, sir. Thank you so much, sir, for taking out time for us. Always good to get perspective from you. On that note, we are taking a break. Coming back quickly, Nifty flat with a positive bias.